In 2000, one of the greatest wealth destruction events in American history began. Not with a crash, not with a headline. It began with a feeling that the market was unstoppable. The technology had changed the rules, that this time was different. It wasn't. The Nasdaq lost 78% of its value over the next 2 years. My name is Mike Adams. I'm the founder of Adams Financial Concepts, and I've been managing client portfolios through market cycles for decades. My clients didn't lose money in 2000. They didn't lose money in 2001. In fact, they made money while the rest of the market was in free fall. I'm recording this today because I believe we're at the beginning of something that rhymes very closely with what I saw in 1997 and 1998. And I want to tell you about it before it's too late to do something. Stay with me for the next 20 minutes or so, because at around the 4-minute mark, I'm going to make you a specific offer. And at the end, whether or not we work together, you're going to walk away with something genuinely valuable. I promise you that. Let me start with a bumper sticker. It was 2001. The dot-com wreckage was still smoldering. Companies that had been worth hundreds of billions of dollars, companies with marble lobbies and Super Bowl commercials and billions in venture capital, were now worth nothing. Absolutely nothing. And someone with what I can only describe as perfect dark humor had put a bumper sticker on their car. It read, "Please God, one more bubble." Well, God may be answering that. Back then, the internet was also going to change everything. Let me take you back further to late 1996. I was speaking at a Rotary Club meeting, about 180 people in the room, business leaders, community pillars, smart people. I asked them, "How many of you have an email address?" 6 hands went up. Out of about 180 people in that room, I told them to remember, when people ask if you had a fax machine, nobody asks that anymore. They don't say, "Do you have a fax?" They say, "What's your fax number?" It's assumed. It was given. That was 1996. Email was about to become exactly that. Not a question, an assumption. And I was right. And I'll tell you a story, not to pat myself on the back, but to make a specific point. The internet was real. The technology was genuinely transformative, and it changed everything, just like the boosters said it would. But the valuations in 98 and 99, they were not real. The profits were not real. The revenue models were not real. And when reality arrived to collect what was owed, it was brutal. One company after another hit the market with an IPO. No revenues, sometimes no product, just a domain name, a vision, and a pitch deck full of hockey stick projections. Billions of dollars flooded in. And then in the spring of 2000, something shifted. The music slowed, and then it stopped. The Nasdaq peaked on March 10th, 2000 at just over 5,000 points. By October 2022, October 2020, October 22, 2002, it had fallen to just under 1,200, 78% gone. History, as Mark Twain may or may not have said, doesn't repeat, but it rhymes. And right now, the rhyme is getting very, very close. SpaceX, Anthropic, OpenAI, the new parade. SpaceX just completed its IPO. $75 billion raised. The company carries a valuation of nearly $2 trillion. And let me tell you something about that $2 $2 trillion number because it didn't appear out of thin air. Behind every major IPO is a syndicate of underwriters, investment banks that take a company specific. They take the company public. They drum up investor demand. And this is the part people don't always focus on. Those companies earn enormous fees for doing it. Fees tied directly to how high that valuation goes. These are not neutral parties. And the projections they publish to support $2 million valuations, they're worth a very close look. Goldman Sachs served as the lead bookrunner. Morgan Stanley, Bank of America, Citigroup, JP Morgan Chase. It was a who's who of Wall Street. And they're not neutral parties. The projections they published to support that $2 trillion valuation are worth a very close look. Goldman Sachs projected that SpaceX total revenues would reach $470 billion by 2030, with $322 billion driven by AI revenue alone. Morgan Stanley projected total revenues of $330 billion by 2030, and I want you to hear this number clearly. Revenues as high as $3.4 trillion by 2040. $3 trillion. These banks made billions from underwriting this stock. They had a direct financial incentive to make investors believe that SpaceX could one day be worth $100 trillion. And their projections, their very public, very official projections, were designed to support exactly that story. I'm not saying these men and women were dishonest. I'm saying that when people selling you something to stand to make billions from the transactions, you should read their forecast very closely. Now, let me put that in context. SpaceX has revenues of less than $19 billion. 5% of what Goldman Sachs says will be their revenues in 4 years. Their revenues have to increase 20-fold in less than 4 years. SpaceX has negative cash flow. The valuation, the $2 trillion number, rests solely entirely on Elon Musk's vision of the future. Space-based data centers, manufacturing on the moon, colonies on Mars. The total market for space is, in theory, infinite. That's not an investment thesis. That's a prayer. And SpaceX isn't the end of the story. It's the beginning. Anthropic and OpenAI and a long parade of AI and space-age companies is forming right behind it. The IPO window is open and the money's flowing. This is like 1998. We may well have a 1999 ahead of us. And 1999 was a spectacular year in the market. The gains were extraordinary. People felt like geniuses. And to understand why that matters, let me tell you about a company that felt in 1998 exactly the same way some of these AI and space companies feel today. Exodus Communications. They came public in March of 1998. At the time, it was described as a leading provider of internet systems and network management solutions for enterprises with mission-critical internet operations. It's a mouthful, but what it really meant is this. Exodus built the infrastructure that kept the internet running. State-of-the-art internet data centers, backup power, fire suppression, on-site security, fully scalable bandwidth, network availability and monitoring. Everything that companies needed to stay online, Exodus provided. Sound familiar? It should. because today that story is being told about AI infrastructure companies, the picks and shovels play, the backbone of the new economy. In 1998, Exodus was exactly that story, and the growth was real. By the year 2000, Exodus was reporting revenues of $818 million, up roughly 174 million the year before, nearly 5 times revenue growth in a single year. Spectacular top line numbers. But here's what else was happening. Exodus was losing hundreds of millions of dollars. The Los Angeles Times reported it. The aggressive expansion, the heavy debt load, the dot-com clients who were themselves starting to fail. It was all accumulating. And when the bubble burst, those clients began to disappear. Exodus had no foundation to fall back on. In late 2001, Exodus Communications filed for bankruptcy. From IPO darkling to bankruptcy in less than 4 years. Revenues growing 1 year 5-fold. Didn't matter, because growth without profit, growth funded by debt, growth dependent on an ecosystem that itself isn't sustainable. That's not a business, that's a story. And when the story ends, the money's gone. And then came 2000. Before I go further, I want to pause for a moment. What I'm describing right now is something I think about the context every client that I work with. And it's something I'd like you to think about in the context of your portfolio specifically. I'm offering a complimentary, no obligation conversation, not a sales call, a real conversation to a limited number of people this quarter. Look at where your money is, what it's exposed to, and whether there are ways you could be getting better returns right now. Now, let me tell you about a tire company. Sir John Templeton said, and Sir John Templeton was one of the greatest investors of the 20th centuries. And here's something I want you to hold on to that he said. I want you to hold this for the rest of the conversation. He said that bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. They die on euphoria. And I want you to think about that word when you use it to describe the mood around AI right now, around SpaceX, around the idea that technology is going to change everything again. Is it pessimism? No. Is it skepticism? No. Is it optimism? Getting warmer. I would argue, and I think the evidence supports this, that we are experiencing right now in the summer of 2026 is the beginning of euphoria. Maybe not full of euphoria, maybe not the peak, but we are inside the last word of Templeton's sentence. And here's the thing about euphoria that most people don't understand. It can last a lot longer than you expect, which means you have time, but not unlimited time. And the way to use that time is not to panic, it's to prepare. Let me tell you about a company called Cooper Tire. From 1989 to 1999, a full decade, Cooper Tire's revenues tripled. Their earnings tripled. Their dividends tripled. They were a profitable, growing, well-run American business. And then the stock went nowhere. It was flat for 10 years. Why? Because everyone was looking at tech, at the internet, taking the information highway, at the promise of digital everything, brick and mortar. A tire company was old economy. It was boring. It was the past. Nobody wanted it, which meant you could buy it for almost nothing relative to actually what it was worth. And then 2000 arrived. The Dow crashed, the S&P crashed, the Nasdaq down nearly 80% over 2 years. And Cooper Tire, the stock price tripled. When everyone is looking left, the opportunity is usually on the right. When everyone's chasing the dream, the reality gets misplaced. And mispriced assets, companies with real earnings, real revenues, real balance sheets, those are where the patient money goes. That's the principle. And it works whether the economy is strong or weak, whether inflation is high or low, whether we're headed into a recession or a boom, whether we're headed into stagflation. The numbers don't lie. And that's what my clients did. And that's why they didn't lose. I want to be transparent with you because I believe transparency is what it's called for. Past performance is no guarantee of future results. I'll say that today and I'll say it at the end. It's true. It matters. You should hold any advisor, including me, to that standard. And with that said, my clients did not suffer the downturn of 2000. They did not suffer 2001. They missed the pain entirely. And more than that, they made money while the rest of the market was losing it. Not because I'm a genius, not because I had inside information, but because we were paying attention to what the market was overlooking. We were patient, we were disciplined, and we were prepared before it mattered. Coming up, I'm going to walk you through 3 choices every investor faces now. Only one of them ends well. And then I'm going to make you an offer that I think is worth your time, whether we ever do business or not. In my experience, after years of managing portfolios through markets exactly like this one, there are exactly 3 things people do when they hear a warning like the one I'm describing. Only one of them ends well. Let me walk you through all 3. Choice 1 is to do nothing. It's the most common response, the most human one, because the market is going up, maybe slowly then some days, maybe quickly others, but the trend is positive. The AI revolution feels real. SpaceX is impressive. The numbers in your account are bigger than they were. So why change anything? Here's why. In 1998, the people who did nothing felt exactly the same way as you might feel now. And 1999 rewarded them handsomely. And then 2000 arrived. Without warning, without a clear signal, without a polite announcement. And it didn't matter how many good years came before, the losses wiped them out. Doing nothing is a choice. It's just not a strategy. Choice number 2, wait and react. This sounds smarter. I'll keep an eye on things, and when I see the bubble starting to burst, I'll move quickly. I understand the appeal. I really do. But here's the problem with that plan. Markets don't send a polite warning. They don't schedule their corrections. By the time most investors recognized what was happening in the spring of 2000, they'd already lost 30 or 40 or 50%. The people who said, I'll react when I need to, were reacting when it was far too late. Reacting after the facts is the most expensive strategy of all. Choice number 3, this is the path that actually works. And I want to be clear about what it means because it's not what most people assume. Preparing now does not mean selling everything and hiding in cash. It doesn't mean abandoning the upside that may still be ahead. I believe there's real upside ahead. And possibly a good year or 2. Preparing now means understanding exactly where you stand. It means identifying the risk in your current portfolio before they become losses. It means finding and changing the portfolio, finding mispriced assets, the Cooper tires of 2026, finding those things the market has ignored because everyone's staring at the AI darlings. It means building a portfolio that can capture the gains that are still coming and that are positioned to weather what follows. It means making decisions before the crowd starts panicking, not afterwards. Nobody rings a bell at the top. But there are people, and I count myself among them, who've learned to read the melody well enough to hear that the last verse is playing. I'm going to tell you exactly what I'm watching now, the specific signals that concern me, specific type of opportunities I'm finding for clients in this environment. So don't go anywhere. Stay with me. Let me tell you specifically what I'm watching. First, the valuation disconnect. SpaceX is valued at nearly $2 trillion on revenues of less than 19 billion. Put that in perspective. That's a price to revenue ratio of over 100. The entire premise rests on businesses that don't yet exist. Space colonies, lunar factories, orbital data centers. These are not investments in what is, they're bets on what might be. Secondly, the IPO pipeline. The SpaceX listing is not an isolated event. Anthropic, OpenAI, and a long list of AI-adjacent companies are preparing to come to market. Each one will arrive with a story about transforming the future. Each one will command a valuation that would have been seen impossible 5 years ago. The cycle is accelerating. Third, the EU signal. The European Union has already begun routing around Starlink. Starlink, of course, is part of SpaceX. That's their $19 billion. The EU is awarding an $11 billion euro contract to competing satellite consortium. The competitive moat that Starlink seems to own, the moat that justifies a lot of their valuation, may be narrower than the market currently believes. And fourth, and this one's subtle, I've learned to pay close attention to it, the language people use when they talk about these investments. It's the words, this time is different. It's this technology is accelerating. When skeptics get dismissed as people who don't understand the technology, when the upside feels limitless and the downside feels theoretical, that's language of the late cycle markets. I've heard it before. Now, this is the opportunity finding. Now, this is the part I really want you to hear. I'm not going to tell you the sky's falling. I'm not going to tell you to sell everything and go away. I'm here to tell you that moments like this one, when euphoria is pulling capital toward the flashy and the speculative, those moments create an extraordinary opportunity in the overlooked and the undervalued. The Cooper tires of 2026 exist. They're out there. Companies with real revenues, real earnings, real balance sheets, companies that are not getting the attention they deserve because everyone's staring at the AI parade. Finding them requires patience, requires discipline, requires looking where other people aren't looking. And that's what I do. That's what I've always done. And that's exactly what this moment calls for. I want to leave you with something specific, a way to find out exactly how your portfolio stacks up in this environment, and a conversation I believe that will be worth your time, regardless of what you decide at the end of it, whether we do business or not. And the only question that really matters, the only question that you need to sit with right now is not, is there a bubble? There is. The evidence is clear. Question is not, will it burst? It will. They always do. The only question that matters, the only one worth your energy right now is this. What is your portfolio set up to do when the music stops? If you know the answer clearly, specifically, with confidence, then you're already ahead of most people. If you're not sure, if the honest answer is, I think I'm probably fine, or I haven't really looked, or I trust my current advisor, but I haven't had the conversation, then I want to talk with you. I'm extending a complimentary, no obligation portfolio conversation to a limited number of people this quarter. It's not a sales call. I want to be direct about that. It's a conversation, the kind I have with my own clients about your specific situation, your portfolio, your goal, your exposure to what's coming and what you'll walk away with, regardless of whether we ever work together. A frank, honest look at where your current portfolio is positioned to capture the upside that's likely still remains, while still being protected. A clear picture of where the exposure is in the AI valuations that are driving today's market and what that risk actually means for your financial goals. Conversation where better returns may exist right now, the overlooked opportunities the crowd has walked away from. An honest second opinion from someone who's been through this before, not just read about it, but I lived through it and help clients come out on the other side better off than they went in. Past performance is no guarantee of future results. I will always say that. But preparation, discipline, and finding what the market has overlooked, those aren't accidents. They're repeatable. Thank you for spending time with me. I hope that gives you something to think about. And all you have to do is book a time and send me your portfolio and let's have a discussion whether we do business or not. That's something you'll come away of value with. My name is Mike Adams. This is Adams Financial Concepts, and I look forward to the conversation. And that's the end. And this time, let me ask if anyone has any questions.